How you doing, guys? Welcome back. This is Dana from Masterland Investing. How you doing, guys, tonight? What I want to talk about, and it's come up quite a bit. I could tell you a story about it also. It's your basic accounting as a land investor. Years ago, like I've talked about earlier, I was turning and burning, myself and a partner. Made more money than I ever seen in my life. At the time, the market was super strong. You couldn't hold a property. We were moving stuff as quick as we got it. Everything we did, 90 days or less, it was in and out the door. At that time, I had a good real estate accountant, but one thing that I neglected, and by no means am I an accountant, I didn't want to pay the taxes all the time when they were due every year. And the reason for that is my theory was, I don't want to tie up all this cash paying the IRS when everything I buy, I can turn to gold. It was pretty easy. If you spent $1,000 on something, you could make $3,000 back. The market was just super strong. So that being said, at the end of the day, one particular year, I think I owed about $750,000 in earned income on my taxes. That was my taxes due. I think it was like a $2 million a year or something. I've learned my lessons since. I had to dump some assets. I've talked about it in earlier lessons. I was able to clear up the debt. Didn't pay any interest because I got to it in time. But it was a pain in the butt. It was a lot of money to pay. I didn't plan well on it. Like I said, I'm not an accountant. So this question's come up quite a bit. And I'm not going to sit here and preach I know everything under the sun about accounting. Investing accounting, it changes all the time. The tax laws change all the time. My advice would be, first of all, and I've said it in one of the lessons, and it's in the course, is it goes back to building a good team. And one of the most critical things, and all of them are on building a team, is also having a sound, competent, up-to-date, knowledgeable real estate accountant. And the reason for that is, like I said, tax laws change all the time. If there's a certain amount of properties that you buy and sell a year, you fall under, basically, I think it's a dealer status. So the tax rate changes a little bit. Obviously, depending on what you turn and burn in a year, your tax rate's going to change a little bit also. So I've given people advice in the past, and I always give it the advice tempered, meaning don't take my word for it, check with a real estate accountant. But typically, every deal you do, I would say call 30% of that deal. If you have $10,000 total out of cash, totally invested in a particular buy, and you sell it for $30,000, these are just simple numbers, and there's a $20,000 difference spread, then call it 30% you want to tuck away into a separate account, an interest-bearing account for the end of the year to pay the tax. So that would be 3 times 2, $6,000. If I'm correct, that goes into an account out of that 20, so it leaves you 14,000. You can feel pretty safe that you cleared on that deal on 20 grand. 2 times 3, 6. So $6,000, which is hard sometimes. You put that into an interest-bearing account, let it sit. At least it collects some interest. And the reason I bring this up is because not a lot of people talk about it. In the lesson plan, in the course that I'm going to be providing real soon here, I'm going to have a couple of links for a couple of programs out there, a couple of pretty savvy investor accountant programs that'll keep you, almost like a QuickBooks scenario, that'll keep you up to date if you want to do quarterlies or just really be on top of the game. You can use those links and use their information, which would be really valuable to you as an investor. Or, like I say, go out and find yourself a real competent real estate accountant that can keep you up to date. Typically, they don't want you to do quarterlies, which is fine, better safe than sorry. But if you're starting out and you haven't built a team yet, and you haven't got a lot of money, my advice would be every deal you do, if it's $3,000 at the end of the day on a deal, and you're netting $3 after cost and after sell, and you got $3,000 total, that you earned on the deal, that's $900, call it 30%. Put that $900 into an account. So at the end of the year, every deal's accounted for, and you know you have 30% of everything you made that's into that separate account, collecting a little bit of interest so you can pay your taxes. Like I said, what I did was I didn't want to do that years ago, and I had a couple, 3 years that were really super years. And at the end of the day, it's really tough to come up with $750,000 when the market crashed and nothing's moving, and now the IRS is knocking at your door saying they're going to take your stuff. They want $750,000 in 30 days, and that's what happened to me. I mean, they wanted, I think, $757,000. And the last IRS agent I talked to, because they're all over the country, so each time you talk to somebody, you have to re-explain your situation, what your circumstances are. And the last one I spoke to pretty much gave it to me clear and loud and clear. Mr. Brown, you have 30 days to come up with that $757,000, or we're coming to your house and taking your stuff. I don't want any of you guys ever to be in that situation. I rectified the problem. I wasn't in default. I just put it off as long as I could because I wanted to use the cash to reinvest. The market had crashed. Times were tough. Nobody wanted to hear my woe is me story, so I couldn't share with anybody. But besides, I'm too proud to share at the time. So I dumped a lot of stuff. I sold stuff, assets I didn't want to sell. I got their money for them, but it was probably the longest 30 days of my life, or probably some of the longest days of my life, because when that call ended, I didn't know where I was going to get the money. And like I said, the market had crashed, so you understand what I had to do. I had to sell stuff that I had $100,000 invested and sell it for 30 grand. I lost a lot of money because of my neglect. So once again, I'm sharing all these lessons with you guys because I want you to learn from my mistakes as well as benefit from my tools and all the learning and all the ways I've learned to make money. But these are one of the mistakes I've made in the past, so don't get greedy. If you make 20 grand, put 6 away on that deal. You owe it to the IRS. Now there's other ways I'll get into later. I mean, you can do 1031 exchanges. That's a whole different video, and I may not do it right now, but that's an expensive proposition, but you're basically rolling over the tax debt to a later time. That's one way to do it. It gets expensive when you want to do it. You got to identify a property and so on and so on. You have so much time to do that. But general rule of thumb is, first of all, build a solid team up. Do what you do best, buy and sell land. Find a good real estate accountant. He's going to ask you to do quarterlies. If you're comfortable with that, do quarterlies. If you can't do that and you haven't got an accountant, at least put 30% away of everything you do, so you have it tucked away. Hopefully an interest-bearing account that you can get at the end of the year without paying a penalty. At the end of the year when your tax burden comes, you go to the bank, you take your money, you pay them, and you move on. So, lesson learned, take notes. Don't forget this one, guys, very important. They don't stress it enough in some of these videos I watch. I may touch base on it again. I'm probably going to write a couple lessons in the lesson plan about it and even reference my experience because I think it's worth listening to. We all get ahead of ourselves sometimes, and it's tough to pay the IRS, but it's the country we live in. We're pretty blessed to have the country we live in and be in this country, so we got to pay our dues. I don't know whether it's right or wrong, but it is what it is. So you want to be stand up. You don't want to be in a bad situation. You don't want to be in a situation the market changes, you can't get your hands on the money. You were doing so great, you went out and spent the money, had a party, shared everything with your friends. I always say be generous, don't be greedy. I say that for a reason. I mean that, use an educated approach when I say that. But if you spend all the money and then they come knocking, you're going to be in a bad situation, you're going to have a bad week. So take my advice on this, guys. 30% at least. Put it away. Forget about it. It's not yours. If you make 100 grand, you made 70. If you make $1 million, you made 700. I probably should say 40%. That's about what my tax bracket was. I told people it was about 45% of everything I made. If I made $1 million a year, I made 600,000. So to be safe, 30%. If you want to be super safe, 40%. I know it's tough. You know, that's a lot of money. 100,000 you only made 60, but it's 60,000 better than zero. So remember that, guys. That's my lesson for the day. Thank you guys for tuning in. I hope you liked the video. Give me a thumbs up if you did, if you think it was informative. If you haven't subscribed, please do so, guys. Love the thumbs up. Go out and inspire, be generous. Try to be kind, guys. Thanks again for tuning in. Talk to you soon. Bye-bye.